I think it's important for you to understand how the industry works on a general basis. I'm not going to try to make it confusing and get too in depth, but I want you to have the basic understanding so that when you talk to somebody, you know what you have is going to save them a huge amount of money and why, okay, and how. So in merchant services with traditional pricing, there's two main structures of how people are priced. There's tiered pricing, and then there's interchange pricing. Tiered pricing is where they have three different categories. They have three tiers. The first one's qualified, then mid-qualified, then non-qualified. This is kind of an industry standard on what the rates could be. So 1.5% to 3.5%, they're going to fluctuate. So to really simplify this, a qualified card is going to be a real basic credit card, not airline miles, no cash back, just a credit card with nothing fancy attached to it. So as they start progressing and getting airline rewards credit cards and cashback cards, and the more rewards that the credit card that the customer is using has, the next tier, they're going to go up a tier and start paying more money. So a lot of people don't understand this, but when a customer, or you, right, we all use credit cards. If you go into a store and you go use a high-end rewards credit card, like I love to do, like everyone out there loves to do because we want our free vacations, it's not American Express or Visa or Discover who's actually paying for those rewards. It's not them at all. It's actually that business owner, right? So that business owner is paying a higher percentage to pay for the higher rewards based on the type of card that they're accepting. So again, to make it simple, qualified, mid, and non, what determines each one is the level of rewards and how big of a kickback they're getting. There's a term in the industry called discount rate, and all this term means is the percent that they pay. You know, their discount rate for non-qualified is 3.5%. That would be how you use that language. And the reason why I bring this term up is because some people actually think they're getting discounts, right? This is not a discount. There's no discount about discount rate. It is simply the percent that they're paying. So if you do this long enough, you're actually going to run into people who are like, no, I'm with the bank. I actually get a discount because I'm with my bank, or I've got the greatest deal. It's even discounted. Okay. They're not getting a discounted rate. They're not special. They're getting a discount rate, which simply means a fee. Okay. It's just the fee that they pay. There's nothing discount about it. Okay. The average transaction fee, again, depending on the type of business, is going to vary from 20 to 50 cents per transaction. They have batch fees. If you don't know what a batch is, this is at the end of the night, they print a report off. And once they do their batch, that's when the money is actually in transition to their bank account. So most businesses batch at least once a day. Sometimes you'll have restaurants that'll batch after lunch, and then they'll do another batch after dinner if they want to separate the two, lunch and dinner. But most businesses are going to batch at least once a day. There's a fee for that. And then you have a lot of monthly fees, right? You have a minimum. You have a statement fee. You might have a on-file fee, a paper fee. You have non-PCI fees. There's a lot of fees going on with the traditional merchant account. So the main thing on tiered pricing, however, is you have a qualified, a mid-qualified, and a non-qualified, and those fees are set in stone. They're a set price. Okay, the other option for traditional pricing is interchange. This is a little more complex. I'm going to try to simplify it, but interchange is a better option. When I did traditional pricing over 9 years, this is always what I did. I wasn't a tiered pricing guy. I always did interchange pricing. It's better for the merchant because on this one, they don't have a qualified, mid, or non-qualified rate that it's set. On interchange pricing, they actually pay a small percent above the actual cost of running that card. So in a couple slides, I'm going to show you what interchange is, but the word interchange is the term for our cost, whether it's Easy Pay, First Data, Wells Fargo, Bank of America, Costco, Elavon, all of us, we all pay interchange, and it's what Visa, MasterCard, Amex, it's what all those companies charge the processor. And we don't start making money until we charge above interchange. So with interchange pricing, we put a fixed percent. This is kind of a range here. So I'm just going to give an example. Let's say I put someone at interchange plus 0.5%. So what that means is we're going to actually disclose to the merchant what the interchange was. We're going to actually tell them, okay, here's what our cost was on this card, specifically this card, and we added 0.5% to it. So on interchange pricing, the processor always makes the same amount because we always would add, in this example, 0.5% on top of whatever Visa, MasterCard was charging us. Now on interchange, the rest is pretty similar. You're going to have your transaction fees, your batch fees, and your monthly fees. Bottom line, interchange is a little bit better, but it doesn't really matter because tiered pricing and interchange pricing still have all these fees. And to be honest, the biggest part of a merchant's bill is the interchange. It's the part that Visa, MasterCard charges is a majority of their bill, and that's a part that no processor can negotiate or lower down. A normal processor can only negotiate and lower down how much above interchange that they charge, because that's where the processor's actual profit is. We can't call Visa and ask them to negotiate their rate for us. Okay, that's not happening. So doesn't really matter because on cash discount program, we just have one monthly fee.